Yo, so what's up, guys, and welcome to this Q4 webinar. My name is Bossman Forex, and we shall be doing this session in two phases. So, as you guys saw from the emails that I had sent out, we shall be having the first session right now, going for about like 2 hours or so. Then the second session will be in the afternoon during New York session timings, and that will be for another maybe 2-3. Since the other one is going to be more of simulation, it might go towards the extremes of maybe 3.5 hours. So that's why I was emphasizing on people being comfortable, because sometimes it can get tiring. But if you're comfortable wherever you are, maybe you've eaten properly, you've had a meal or so, coffee, get comfortable. We'll start in the next 2 minutes or so.
Hello, Bossman.
Hi.
Hey, I wanted to ask you, like with US30, when do you usually anticipate your setups?
Yeah, we've not yet even started the session.
Oh, you haven't even started. Okay.
I've not even started the session, so I'll deal with your questions. There are going to be sessions of Q&A. So
okay.
because most of the questions I saw guys were asking are questions that I'm going to answer in the course of the program. So
okay, nice.
Just keep calm. Okay.
Okay.
Awesome. So we can start. It's 11:03 or 8:03 GMT. So I think you can start so that we have ample time to go over these things. So the first few minutes I'll go over just in order to break the ice. I saw a couple of people had asked me about, what's it called? Some people had asked me about broker preferences. Some others had asked me about whether I use funding programs. So I'll use this time to actually get through those questions first, the ones that I don't need to go through because of the strategy. And then for anything remaining, I'll go through those questions towards separate periods during the session. So let me share my screen real quick. So this is, so I'll start with a disclaimer, and the disclaimer is Forex is a very, very risky affair, and you need to only trade that which you are and that which you are able to lose. Don't trade with money you can't afford to lose, and so many other things. It's Forex profitability and consistency is a product of very many things. So it's not just about knowing your strategy; it's also about knowing your mental state, your strategy, as I've mentioned, your risk management protocols, and all that kind of stuff. So broker recommendations, I've personally been using IC markets for the longest time. They offer the best in terms of spreads. They offer almost all instruments from CFDs, commodities, indices. They have all that, and they have the best platforms in terms of MT4, MT5, WebTrader. I'm not affiliated to them, so that's just my recommendation. Yeah, they have so much. I prefer using these three, CTrader and MT4 and MT5. CTrader is good for copy trading in the event you have more than one account. Then MT4 is what almost everyone uses, and then MT5 is more like a revised version of MT4. So this is the broker that I usually prefer. I've used it for the longest time after skimming through various brokers, and I've found that this is more or less the best broker that I've encountered. And their withdrawals are processed each and every day. So that's also a good thing. And given that I've made my withdrawals, I can certify that these guys don't run away with your money. Then in terms of the funding program recommendations, so far FTMO is the best that I've come across, given that I've been testing these programs, I think since July or something with the community. FTMO, I had tested FTMO and Funding Talent, but Funding Talent is no longer in service, so we have FTMO. This is a very decent company. They are, as you may guess, they also pay out, so that's a good thing. And I think at the moment they're running a 10% discount on all challenges. So if you want to sign up, again, I don't have an affiliation link, so you just go to FTMO and then look them up and you can sign up. Funding programs are good for people who don't have ample capital, because I don't recommend people trading with small amounts like $100, $200, $500. It's not recommended because you'll end up wanting to get big rewards out of small accounts, and then you'll end up over leveraging or over trading and doing things like that. So I recommend that if you have small amounts, just invest in knowledge first of all. Then when you're ready, you invest in a funding program, and it can really escalate your trading opportunities. Then now we have cashback. Not many people know this, but there are a couple of brokers that actually take commissions off each and every trade that you place. So for example, for IC markets, I think their commissions they compensate for the very low spreads with commissions. I think it's $7 per lot. So when you link your account to a cashback program, you do get cashback, as it sounds, just as the name suggests. And through this cashback, they pay you once you get to a certain target. So I think it's usually, I think about $100. Once your cashback gets to like $100, you can get that cash back. So it's basically the commissions you pay, you get a percentage of them back, and they're paid back to you. So that's why it's called payback effects. It's a very decent program. I've also used it. This is what I use to more or less minimize the damage that the brokers do in terms of charging for every position you open. So that's payback effects. I'll share all these links, so you can actually just look them up. This is IC markets. Then this is I think I can actually put them in the chat box. Let me just drop them here. So we have IC markets. Copy that. Again, I'm just suggesting platforms that I have used in the past and that I am currently using. So I'm not recommendations. So there we go. We have that. Then we have FTMO. You can look at them in your free time. Then we have payback effects. This is actually a really good one, because most, if not all, brokers charge commissions. So it would be good to get back the money that you usually get from commissions, especially if you use large lots. This usually pays up a lot. Then we have the simulator. So for me, the simulator that I've always been using is Soft4FX. And it's good because you'll also see the benefit of having a simulation platform once we do the simulation session in the afternoon. So this one is Soft4FX, and it's decent. I don't know how their rates are nowadays, but I believe you can get a nice package of them. And then now we have finally TradingView. I guess everyone knows TradingView. So this one is also good for simulation. So you can get the paid version, whatever it is that suits you, you can be able to get this. So TradingView platform. Yeah, There we go. So I think I'll pin all of this. I don't know whether you can. I don't think you can pin, but I've shared them on the chat so that anyone who wants to refer back to that can be able to get access to it. Now we can go straight into the webinar. So just one last thing. Let me share this screen. There's a platform called Slack that has a community that I have been running for a couple of months now. So those guys will be getting access to the recordings. So if you want to be part of the community, as I usually share almost always, the community is available at, it was initially available at $50, but now it's available at $35 so per month. So if you want to sign up, the sign up link will be provided on my Instagram page. If you can email me as well, you can still get access to it. So I think I've gone over everything that I wanted to go over during the preface, so we can go straight into what has brought us here today. Yeah, we've spent like 5 minutes, which was good. So now let's go to the whiteboard. And then just one more disclaimer. If you want to ask a question, I'd suggest maybe rather than unmuting yourself and just asking a question, just raise up your hand, and then an admin will help me in getting to you and your question. So that's just to have order while we are having this session. So yeah, now we can start. We'll start with introduction to basically Forex. This is just skimming through as we get into the bulk of the session. So chapter 1 is introduction. Okay, now so Forex is something really vast. It's something that has been going on for a couple of months, I mean years, months, years, and decades, whereby people have been putting their money. It started off with people actually going onto trading floor. Let me just, I don't know why I'm muting themselves. Yeah, I think that's better. So it's been going on for some time with the Forex thing, but over the years it has been improved and all that kind of stuff. So under introduction, we'll talk about understanding why the market moves the way it moves, what kind of pairs. Actually, for today, we are only dealing with US30. So I'll just skim through the introduction, and then maybe you will understand more about what I'm talking about in the next few minutes. So keep in mind that the strategy that I'm talking about is going to can be used on any pair, and I mean any pair, not only US30, only that today's session is going to be more or less fixed on US30, because I've noticed a lot of habits that US30 has over the months that I've traded it. And then all you just have to do is just go back to the charts and look through the charts, see if the strategy makes sense, blah, blah, blah. Yeah. So the most simple thing that people ideally know in Forex is market structure. Okay. So we can start off with market structure. On market structure. Now, under market structure, this is basically simple stuff. It's basically a merger between highs and lows. Okay, so maybe we can have highs here and lows. So under this highs and lows, market moves in phases. So market starts with, if for example, I can draw a chart here. So let me just look for a simple box you can draw here. And then I will say this is our chart. So this is where price is, and this is where time is. Okay. So price doesn't just move like this. Say price wants to push from $1 to $10. Price doesn't move linearly. It moves, okay, you can see there's one question already. You can leave your question. You can leave your question in the chat box. If the problem is also audio, you can still feel free to tell me that in the chat box. There's somebody who's going to be sorting that out. So we were going over, that's especially with regards to Marco. I've seen Marco has shared that, raised his hand. So say price is pushing from $1 to $10. Okay, simple stuff. You don't expect, let's say this is EU, okay, and EU is pushing from $1 to $10. So you won't expect price to push in a linear line. What you expect price to do rather is push from here, form a high, form a low. Now, this is a low regardless of whether it's broken this low or not, right? So this was the most premium low, I mean, most discounted low. And then this is another low, then we have this high. And then we see price progress in that similar fashion. Sometimes it might go all extreme and then it might come and make a correction. And then we might continue all the way until we get to this point here, okay? So this is market structure. So we have a low, a high, a lower high, a higher low, sorry, and then a higher high, because this high is higher than this high, right? So that's a higher high. Then this, until this point here, this was the highest high, but you can still call it another higher high, okay? So we can continue, there was this low, then there was a higher low, and so on and so forth. These are just details that you don't really need to perfect, but you just need to understand how market moves because it will help us in the future. So we have that, we have this low and so on and so forth, all those lows and all these highs until you get to this point. Now, the reason why market structure moves like this is because price has to compensate, okay? Remember, this is a market that has a fixed amount of money here, okay? Let's say it's 3 trillion, right? 3 trillion. No one is going to come and inject more money to pay for the people who are going to have won trades. The people who win trades are compensated for in this 3 trillion from the people who lose trades. So that means ideally, if the net at the end of the day, if we started the day with 3 trillion, at the end of the day, this has to still balance out at 3 trillion. So if that's the case, then it means that there has to be people who lose and there has to be people who win, okay? So how do you get people to lose more? You only get people to lose more by manipulation, as people would call it. So if everyone is expecting price to push up in this kind of fashion, that means that whenever price is pushing up, people will start buying at this point, okay? Amateurs rather. And when price is dropping, people will always find themselves selling, okay? And the same thing happens. People see a high taken out, they maybe start buying here, then they see price come back down, they start selling here. So the whole essence of market structure, and this market structure is whereby when price is in a bullish run, you want to form a big candle or a series of bullish candles so that you can induce people into buying, okay? You induce people into buying. Once somebody buys from this point, majority of the time, people usually have buys here, either have stops below this area or some others don't even have stop losses, right? So all those people have to be compensated for by a bearish push. Once this bearish push happens, what does it form? It forms a low, okay? So remember, prices come from somewhere. So let's say this was where it came from. People see this bullish push and they get induced or they get triggered into thinking that price is going to continue forming highs. What happens is we see inducement and price gives a shift and now we start forming a low, okay? Now, this person who was trading here probably sees price drop with a significantly big candle, big sized candle, and says, okay, let me close out my trade. And now I start looking for sells. So they sell at this point, once we have gathered enough orders at this point, what happens next is if price was to go up, it will continue up, okay? So this person here who took sells, remember this person who took buys at a very high point has gotten taken out. This person here who has sells with stop losses above here has also been taken out. And the cycle continues with formation of highs and lows. Even when price is in consolidation, consolidation is meant to trap people, meaning that anyone who wants to buy once you get to this premium point is taken out, and the same goes for somebody who's trying to sell out of this point, okay? So that is basic market structure. Now I have touched on something that I was supposed to touch on next now, which is, now, if we understand how highs and lows are formed, there are instances where we have, now we can erase all this. I'll be looking at the chat box every 10 minutes or so. So if you have any question, feel free to leave it there. And if I see that I'll be answering it in the course of the session, I won't address it at that point. So now, if we already understand how market structure flows, we've already said market structure flows in highs and lower highs, and the same is for when price is going down. So we've touched on something very interesting, whereby we said that when price is pushing up, we accumulate order accumulation. So sometimes orders can't be accumulated in prices, breaking highs and breaking lows, right? What happens instead is when we are accumulating, we form consolidation areas. What I mean by consolidation is contrary to the case whereby we have highs taken out. Some people will call this a trending market. And the same goes for a bearish case, right? A trending bearish market and a bullish trending market, whereby lows and highs are being taken out. For us, there's also the case whereby there's times when market is not trending at all. And in such cases, what we usually find is price normally has a ranging market. People will call it a ranging market. And the reason why it's called a ranging market is because price stays within two more or less areas, meaning that when prices, say wherever prices come from, if prices come from up or down, and price stops an area whereby it doesn't have enough orders to manipulate. Remember, we were manipulating orders, right? So when you don't have enough manipulation orders, I mean, you don't have enough orders to go against them. Remember, if all you have to do is just trap enough losers so that you can go against them and take their money, okay, so that you can compensate for the wins, right? So if, for example, we want to go down, but we don't have enough volume, or rather, we don't have enough orders to continue going down, right? So we are going down, but then we don't have enough orders. What does that mean? Or it means that for us to continue down, okay, we've even gone outside our box, but it's okay. For us to continue going down, what has to happen is, once we tap an area on the charts, price has to create a selling scenario, okay? So that people can start selling at this point. What happens when people start selling at this point? Their stop losses that are piled up around here are taken out by one push or so, okay? Then once they see this happen, some other traders who are now waking up, remember these guys are probably taking the trade and then they get stopped out, they sleep. The next batch of traders here, since we still don't have enough volume to go down, what do? These people think that we're going up because maybe we took out some lower time frame structure. Price progresses down. And then if we have enough volume and enough orders, we can continue down. But if we don't have, what happens is price continues in this range. And it will continue like this until it gathers enough orders so that we can continue in the certain direction. So all this time in ranging markets, we're usually trying to figure out the direction. Now, for us, since we're not the market makers, you can't assume you can't assume the direction. You can't say that. You can't definitively know where price is going to be going to. So majority of the traders really end up just waiting for a breakout of consolidation and the like. So, but maybe I'll touch base on that a bit more. But all I wanted to talk about with regards to this is that with this kind of formation comes in where brings in supply and demand. Okay, so that's going to be the next thing. So now when we bring number 2 here, we now map supply and demand. Okay, supply and demand. Okay, so and we've touched on a very interesting one, which is zones. Okay, so zones is really the most important thing when we come to supply and demand, and that's what I was just touching base on, trying to make you guys understand where all this comes from. Okay, so zones come from this kind of consolidation. As I've said, some people will call this a ranging market, others will call this a consolidation box, but for supply and demand, we call it a base. Okay, and this is one of the most important things in terms of supply and demand, whereby you have a base. So since now we're talking about supply and demand, just know that for supply areas, okay, I think we can even take out this right now, since I believe everyone has understood that portion. So for supply and demand zones, we have supply and demand. All this brings about is one of them is coming from an extreme point of an extreme premium point, or rather an overpriced point, an overbought point. Another one is coming from an oversold point. So for supply, it's coming from an overbought point. Overbought meaning that there's too much buying that has happened and we need to compensate for that. So say we take a case of price dropping. Last time we used a case of price pushing up from $1 to $10. Let's now use a case of price going from $10 back to $1, right? So price wants to come here, but as I've mentioned, it can't come all the way down. What it does instead is, let me start from 10 all the way to 1. What it does instead is it drops, okay? Then it gets to a point whereby it does not have enough, like we all know it wants to come here, right? But we don't have enough volume to push us all the way here. So we need to continue accumulating orders. Remember, this depending on where we've come from, remember we came from $1, right? So people are still thinking that since we tapped this area, we might be going up. So what price does is it forms that accumulation, okay? And then once it has gathered enough orders, it continues. And it continues doing the same thing until it gets to our $1 area, okay? So of interest here is usually, now let me use circles to highlight these areas. We're looking at these areas now, okay? That area, this is our oversold, this is our overbought, okay? So for our case here, what you can see is we have left behind, while we came from this overbought point, we have hints that the market is leaving behind. So we have that area, we have this area, we have this area. Remember now what you've now left behind are supply zones, okay? So for every, this is like one supply, okay? This is another supply region here. There's another supply. There's another supply. All the way until we get to, let me just minimize this one because they'll give us an issue. All the way until we get to our oversold point. All right. So now remember this overbought point was coming from a place where price had just rallied into that level. So now that price has dropped into our level, it makes this a very good point of possible shift. Okay, Now, let's say we knew all these things beforehand and we knew price was going to shift from $1 back to $10 or even more. That means that as price is pushing, it will do the same thing and push all the way up, right? So what have we done in this case? We've put, let's say when price halts at this point, so that because that's what the screen is getting to. What we've left behind are, now we've pushed from one extremely oversold point to an extremely overbought point, okay? These things will make more sense on the chart and on the simulation session. So what we've left behind is once we tapped this region and we started shifting, we saw a formation of a base there, a formation of a base, a formation of a base. What's the difference between this one and the first one? This one is a demand zone, okay? Here's another demand zone. Here's another demand zone. Here's another demand zone, okay? So right now I'm still sharing like the basic concepts of supply and demand so that you guys can more or less understand where all this is coming from. Let me just minimize these ones. Feel free to drop the questions. I'm about to look at any questions that are there. So if you have any questions so far, you can drop them in the chat box. So now we have pushed from an extremely overbought to oversold. We left behind a supply zone and minor supplies, and then we tapped demand and minor demands. Okay. Now, you may ask now that then what is the significance of these levels, right? If at all we are trading off these levels, then what's the significance if price is going to always continue going down? And this is where the basic supply and demand comes in. Basic supply and demand tells us that when price is pushing into a supply zone, basic supply and demand will tell you that when you're at a supply zone, sell, and when you're at a demand zone, buy. That means that when the base is formed, let's say that is a base, and price comes back, what you expect is price to give you hints that it wants to go lower and shift from that point and continue. Okay, so ideally what you're waiting for is when price is maybe somewhere like here, we see price shift like that, and so on and so forth. And the inverse is true for a bullish case, whereby if price leaves behind a demand zone, we have this happen, okay? Because we've tapped a demand area, so we are pushing up because basic supply and demand tells us that you buy at demand, you sell at supply. Okay, so that means that even for the cases here, you will be expecting once price forms this base, you'd be wanting to see that, and you want to see that, and you want to see that. Now, where this merges with market structure, remember we talked about market structure, is the reason that I was telling you. In this case, all we've just formed is we formed a low, a high, a high, a high, a high. Or we formed high, then low, 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 right? The point that this comes in is whereby when price pushes up and forms a high, let's say for example here, and we left behind a zone here, the essence of the zones here is that we form the structure now. Okay, so if there's a demand here, you time it right such that this low that is going to be formed is going to fall along the lines of market structures, that as we progress higher, we leave behind this whole demand zone. Then the same happens now, since we've left this demand zone and we formed this high, we'd want to see that same thing happen. Top of that demand zone coincides with a low, and then we progress. And the same is true here, whereby if you have the supplies, then we form a base. You want to see this sudden sort of like reversal not work, and we see the continuation forming another high here and another high here, a lower high, higher low, higher low, and so on and so forth. I hope I've really reiterated that point, because that is going to help us in the coming minutes. So Just 1 minute. Yeah, there we go. So we have more or less broken down market structure and supply and demand zones. The thing that I want to do is I won't tell you like all those nitty-gritties about what zone, how to draw a zone, all that kind of stuff. If you want to go through that, you can go through, I think I have videos all the way from, one thing that doesn't change is how to draw zones. So I have videos even on my YouTube, I think from like 1 or 2 years ago or 3 years ago, that basically just share how to draw zones. So you can go back and look at that. Now the bulk, let me just take some water. Now, the bulk of understanding this alpha strategy is trying to dissect, like, how do you know, a main question that people usually ask is, when do you know when to buy and when not to buy? Or when do you know when to buy, when to sell, right? Because there's sometimes demand zones will be formed at extreme buys and people will just continue buying. And then because you failed to buy the first time, right? And then because you're supposed to buy here and it played out so well, and then it formed another one, and then you failed to buy again, right? And then now you full margin on your last one because it's been doing the same pattern over and over again. And you buy from here and price automatically takes out all this, right? We've all had instances of this. So how do you counter all these times that you've maybe lost out, or even there are cases whereby price will take out a zone and then continue in your favor, and then you're like, Forex hates me, blah, blah, blah. So that's ideally what you're going to go over right now. And I'll just skim through it because, as I mentioned to you guys, the bulk of the information will be shared on the simulation session in the afternoon. So now comes in. So just one last thing. Actually, I think we'll go over it in this next section now. So supply and demand zones, we have zones, and we have, as we've just talked about, supply and demand. That's it. Then now we have maybe one more thing to add. We have minor ranges. Now I didn't want to bring up this term right now, but because I've already brought it, because I've failed to get the best kind of terms to use here. I'll just bring it up right now. I'll bring up the term ranges. Ranges is basically, here I have reiterated on minor ranges, meaning that in the future we're going to talk about other ranges. So for the minor ranges, what it is basically is every time price pushes to a certain point and then comes back, all price is telling you is, look, we have history here. The last time you were here, price pushed all the way here. And so the anticipation is, if we reject this area the same way we did the first time, price will fulfill this same push at least until this point. And what we leave behind is, this was a zone, it formed, so this was a zone, it formed a range, and so this becomes our minor range, okay? So to me, this now shifts from becoming just a zone and a push, and it becomes a zone and a range, meaning that it pushes from this area all the way to this extreme. We'll call that extreme P. And then when price comes back and we get this, the same rejection, you expect that the range will be filled, okay? Now, in our case, it is minor range. Now, as we come to the close of just explaining supply and demand, one thing that I'll just mention is, you can actually stop here and just build a strategy of taking buys at every demand and sells at every supply, okay? Meaning that you can just be plotting a zone, you wait for it to form a range, you place a pending here, and you do the same thing over and over, day in, day out. The thing is, the thing is, especially when you use pending, you can easily get 1:2, 1:3, okay? 1:2 setups from here, stop loss below, and you target this area, you can easily get 1:2, 1:3 setups daily. But now the downside is that your win rate will be a bit lower. Okay, same goes for bearish case. You can literally just be placing pendings. I'm saying that because I've been there. The only problem is during the scanning process, whereby you're just looking through the charts, you might miss some good setups, and then the places where you place the pendings are the bad setups, and then you might end up losing out a lot. But ideally, just understand that this in itself is a strategy on its own. So if at the end of the whole idealization of this strategy, you find that you are really not understanding or grasping whatever it is that I'm explaining, you can fall back to this strategy. It's a very simple strategy, and it works with numbers, meaning that the more setups you take, the probability end with really nice, very, very precise pendings and very precise targets, you will, and very sharp and very precise stop losses, you'll end up winning on the long run. So that means if you take maybe 50 trades in the course of a month and you get 50% of them right and 50 wrong, that means that you still end up quite positive in your trading. But now the third chapter that you're going into is now what is going to maybe try and refine. It's going to refine the strategy. That means that you'll maybe get less losses. And then at the same time, but the only downside is it might reduce the number of trades that you take. But on the flip side, it will increase the risk reward that you get on your trades, okay? And I'm saying this because if you grasp it the way I've grasped it, you can easily catch 1:9, 1:10 positions. I think the guys who've been in the group can attest to it. You can catch 1:10 trades. Sometimes you can even catch, depending on how much the volume there is in the markets or the perfect timing, you might even catch a 1:20, 1:30, okay? So that is what you're going to do in now the next chapter that we're going into. Now this chapter is now whereby we're going to, while I'll just call it the alpha strategy because that's what the company and what we use in the community. That's why I'm just calling it the alpha strategy. You can call it whatever it is that you want. Okay, so here is number 3, whereby we just talk about alpha strategy. Okay, so now under this alpha strategy, we have key things that you need to know. And now, because this is with regards, let's see, when using pending or limit orders, is there a hack to reduce the drawdowns from entry? One thing that I've noticed out of just using the pending idea is don't take positions manually, because sometimes when you're taking positions manually, you want to get in a bit early or you want to get in late. So you have to be very precise. For example, if we draw a zone here, okay, maybe price forms a base there. So the base is here. Okay. Let's say the candlestick looks like, let's zoom into that area and maybe you say that the candlestick looks like this. That's the one for the base. And so when you are drawing the zone, you drew it like this, right? Now, that is what happened. That is what is here. So basically, this is just a magnification of what is happening here. Okay, that is what is there. So a hack maybe that I've known really helps a lot with regards to minimizing the drawdown. Remember when I was talking about a case whereby price is pushing and it forms a zone, but then when price is coming back, it takes out some liquidity and then shifts in your favor. So this normally is really just by a candlestick that comes like this, but then closes back within, forming liquidity. So a hack that I've seen to work is when you place your pending. There are 3 places you can place your pending, okay? You can place your pending here. just at this extreme. This one will catch almost every trade with your stop loss below, and then your target at the next high, at the high, right? The thing about this is the majority of the time, if you give ample space for your stop loss, you'll get a 1:1, 1:1.2, okay? On an extreme case, 1:2 on an extreme case. Then there's a case whereby you place your pending at this point. There's even a case where you can even place it at 50% of the zone. So that means if, say, for example, this is 10 pip, this is a 10 pip zone, you can place it at the 5 pip point, and then you just place your pending here. Stop loss is still at the same place. Okay, then the target is still at the same place. All you've done is just pushed your entry a bit lower. Now, this one also has good trigger win rate, meaning that your trigger, the entry points normally usually triggered a bit often. This one has the most triggers because it allows for the times that price is very bullish, for example, and it just taps this level and then shifts. This one is good for when price wants to close within and without, and also if there's a case of just liquidity and going. Then this last one, which is either between this point or maybe where this low is to me the best. But now the downside of this, the upside is you'll even get a risk reward of even 1:5, because you can imagine maybe this guy, since this zone is 10 pips, and then he's adding another 5 pips for stop loss. He has a 15 pip stop, but then for you only have a 5 pip stop. And if the target is still, let's say from here to here is another 10 pips, for him, he's risked, let's say this is 15 pips. That means he's risked 15 pips and he's gaining 15 pips. So that's 1:1. For you, you've risked 5 pips from here to here. And then remember, this is 10 pips and then this is 15 pips. So for you, you'll end up getting a total risk reward of 10 plus 15, which is 25. That's a 1:5. The only downside is you'll need to use this in a very volatile market, say something like GJ gold. I wouldn't suggest it on US30 because of something I'll mention just now, but it works most of the time. But if you want to use it on US30, use it when it's not an open session or whatever it is, because if you use it on an open session, this liquidity will definitely be taken out, as I mentioned just now. So I hope, Pete, I've answered your question with regards to that. Let's now undo all this. Go into the alpha strategy. I hope I'm not leaving anyone behind. There we go. So let me minimize this chat box. Now we are going into the alpha strategy. Okay. Now, the first thing to understand in the alpha strategy, and this is something that if you grasp how to draw this, you will be ahead of the curve. In my perspective, this is what has helped me a lot, right? So for me, understanding major ranges is key. Okay. Now, major ranges, we're going to talk about two things. Now, I hope everyone has maybe this snapshot so that I can delete everything that is inside, and then now we can start afresh. Okay. So up to this point, up to this point, you can literally use this analogies on any pair, even with the basic alpha strategy that I just mentioned just now. And then after that, the tweaks are going to be mentioned at the end. So as we mentioned when we were talking about the $1 to $10, right? One thing that we know is that this is very overpriced. Let's say, for example, this was a muffin. A muffin, let's say our muffins usually go for about $5. Okay, let's say the muffins go for $5. That means that at any given point, in the event the supply or demand chain, like either supply increases or demand increases, right? Demand for the muffins increases, so that means the price has to go up. The supply, if the supply of the muffins goes up, but then there's no demand, the price will go down, right? That's simple supply and demand laws, even in finance and all that stuff. If our standard price is $5, what we are almost assured of each and every time is that price will go extreme, but we know that majority of the time, especially for muffins, not unless you're going to a very lavish restaurant, you can't get for a muffin more than $10, and you can't get, even if you go to the most ghetto places, you can't get a muffin for less than $1, right? So these are our extremes. And this is going to bring in, the addition of this 5 brings in a very important point that I want to bring about. So that is going to be premium and discount, okay? So majority of the people who know about supply and demand have probably heard about premium points and discount points. As you guessed it, discount points is when price is overly sold, okay? And premium points are when price is overly bought. No, it's just like an analogy. I was just using an analogy. It's just like trying to make you guys understand the laws. I would have even used a cake. Like a cake will never go for more than $10 and maybe never go less than $1. I was just using an example, okay? So that I can bring in the concept. So premium points and discount points, okay? Premium is when price is overbought, and discount is when price is oversold, okay? So remember when we were doing our chart, initially we said that price pushed like this, right? And then I think we ended when we even took out this, okay? So the same thing happens on the charts. Say we are looking at EU again. EU will push from an extreme low or a discounted point and push all the way up to an extreme overbought area, okay? Now, there has to be, like for us, for me now, what I'd term a range is when price, this is also correct for price pushing from overbought to oversold, okay? You just need to flip the ideas. I usually like using a bullish case because bullish cases are what I've seen are clearer for me. So price pushes from $1, okay, and pushes all the way to $10. So when price was doing this rally, it gave us a range because after we got here, price failed to continue higher. And what it did instead, it started dropping. Okay, now remember we have 1, we have 10, we have 5. 5 is here. Okay, so 5 is at the midpoint. Okay, now I want you guys to look at, I want to circle key levels, key areas rather, so that we can start dissecting this range concept. Okay, we started from here. Okay, we pushed to this point. We started dropping down. So there's another key point. And then now we have this area here. Okay, so these key levels, I'll even change the color as we progress now. These key levels are where we're going to be keeping most of our attention at. Okay, so we have this area, we have this area, this area, this area. Okay, now the chart that whatever I'm about to draw is actually going to explain like what I look for here, I look for here, here, and so on and so forth. Just keep in mind that we can't know this level until we know this level. So I can even push this arrow here now. Okay, can even, don't think we need this. Maybe we can reiterate that again over there. So that we mentioned that we have extreme low, extreme high. Once the extreme low and extreme high is formed, depending on the things that we look at this point, then now we have this sudden shift back down, and then we have this level. Okay, those are the key levels when plotting a range. I can see Andre is asking if you'll get a copy of the recorded webinar. I mentioned that the recorded webinar will only be available to those who are part of the community. So if you want to get access to it, you can sign up for the community, or you can take as much as you can from this session, and then you won't need the recording. Either of the two. Because this is basically something I'm supposed to charge for, but I'm giving it out for free. So let's continue. So these are the key levels I want you guys to look at. Okay, the inverse is true for a bearish case that starts shifting bullish. So I will erase this and now start plotting actual clean lines here. Okay, so point one. Remember how we were talking about, even before we start this, talk about liquidity. Okay, liquidity might have various explanations to it, but to me, the best kind of explanation towards liquidity is there's liquidity points and there's liquidity. Okay, ideally what I usually like to think about it is when price rejects a certain level with a wick, right? Say, for example, there's a nice rejection from a wick. We look at this on the chart. Then price goes, but then fails to give us a good push up. Price normally comes back again and maybe does the same kind of push. Okay. Ideally, when we get such pushes, we usually want to see, like, for example, if a push happens here, if a push happens at the right point, usually want to see tap and a rejection and a continuation in the opposite direction. Okay, this becomes a liquidity point. Okay, because we tapped this liquidity point and then we pushed higher. Okay, now when price taps a level but then fails to progress in a very aggressive push towards the opposite side, what price does is it tries the second time. It might even try 3 times. It comes to the same area, the same level, does the same thing again. But if it's not at the right point, okay, if it's not at the right point, price will end up trying and building more liquidity. And when it figures out that this is not the level that will give me the returns that I need, what price ends up doing is it comes with a bearish candle and eventually takes out all this liquidity. So remember, this was a liquidity point. Even this, for the first time, it was a liquidity point. Okay, then liquidity point again. But then when price fails to respect the liquidity point, what we've done is we've built liquidity. Because almost every other retail trader will think, okay, if we rejected this the first time, the second time, we'll definitely need to tap this area and shift the third time. But what they don't know is that if we are failing to push from this area, that means price has its eye on an area below us for us to see a shift up. And that's where this lower area comes in. So price basically built liquidity, takes out, liquidity point, builds liquidity, takes out liquidity, forms a new liquidity point. And if price is aggressive enough, it will now come back and shift. Because we all know price wants to go up, but if it's not trapped enough orders, it takes out the liquidity, and then we push up. Now that I've mentioned that, now we go into the bulk of how we are plotting these zones. It was very important for me to mention that. Okay, so in our case here, when you're forming this so-called range of ours, remember price wants to push from $1 to $10. That was our range. So that is the range that we want to see price form. What price usually does is, before it taps to this area, remember we want to go up, but you can't go up from $4 or $5. You need to get the most discounted price point so that you can be able to go higher. Okay, that's where these areas come in, because for us, we can see that we have our very discounted point at $1. So what price does is it builds up, it tries pushing from like the 2, the 3, the 4, fails, tries again, fails. Then once it starts building this, sometimes liquidity is built by equal lows, sometimes whereby there's a candle, there's another candle, we call this equal lows. Sometimes it forms with lows that are not equal, but they are more or less like, for example, this one is taken out by this one. So now we'll call this structure, because if you look on the lower time frame, it's structure, right? So this is where also market structure comes in. So price is literally just consolidating. But then when it has built enough liquidity, it needs to trap all these people. So what does it do? Price comes in, and since we've built liquidity, using the rejection marks at all these points here, price makes an aggressive push to the downside. Okay. Remember how I've plotted that whole idea behind like the zones, blah, blah, blah. If you look left from this point, majority of the time you'll find a zone here. And what price was doing was, if we had the zone here, it was building interest for the zone below it. Okay. But because it's not yet time to buy, price builds up liquidity it builds up interest for this zone. And since now we have a zone, price gets into the zone, taps it, and then if we get a nice rejection, it gives us the continuation. Okay, so that's exactly what happens if you look left. But say we didn't have anything left on the left side. All we'll just see is a takeout of all this liquidity. Then after we take it out, and if price is strongly bullish enough, we now see the rejection up. So we've said that the key thing to look at around here is liquidity points, as I've mentioned, this area here. Okay, the thing to look about at this area normally is usually a very aggressive drop. And as it's usually forming, it's usually just a candle that takes out all these lows majority of the time, or maybe like a series of like one. And then actually the best thing to explain here is, as price is consolidating, let's say it's consolidated, what it usually ends up doing is it forms a supply. Okay, like we are now in this phase of pushing up. Like what has happened here is we've pushed up, we've pushed up, we've pushed down, we pushed up again, we formed another one, and then as price is pushing up, it forms a zone. Because what happens next is, since we are not getting the volume that we need to push lower, price comes in and then takes all this out. So as it's forming, it might sometimes form with one candle, and then the next candle comes in and then takes out all these lows. So as it's forming, you can see it's maybe pushing on, and then once it taps our level, it ends up leaving a rejection candle. Okay, so something like this, something like that. Okay, once it forms something like this, and it's something we're going to talk about just now. Once we see such kind of rejections on the lower time frame, there's a concept that we talk about called break of structure. Okay, I'll talk about it more, but let me just bring it up right now. This is basically break of structure. So remember, the first thing that we look at is liquidity buildup. Then second thing, liquidity taken out, right? Then after we see liquidity taken out, the third thing is we look for break of structure. Once you see, liquidity taken out is with a significantly strong push that takes out all this liquidity. Then once we tap a level, we see a shift because there is lower time frame break of structure. Now, keep in mind that for every move that we see on the higher time frame, it has to build in from the lower time frame, meaning that if price wants to reject this level on the higher time frame, that build up needs to start from the lower time frame. So if you time it right, And you see, let's say this is our lower time frame zone. If you time it right, you can be able to get nice break of structure here, and you ride it with lower time frame entries. But then remember, if we reject this area, you get higher time frame exits. Now, from the guys who are part of the group, you'll know that NYC, New York's session for US30 usually trade it based off M1 and M3 most of the time. So that's the reason why. So we've mapped out the 3 points so far. Okay. Now remember that we've said that there is a zone that is left behind. Okay. Remember we've said there's a zone that is left behind. This zone or this area here, right? So the rejection has to build out by now giving us a bullish push that takes out this supply. Okay. So basically we see a push that continues and maybe takes out this supply. This is the next significant point, because if a supply is not holding for drop, that means that this minor range, remember what we were talking about ranges, if you're expecting a range to go in this direction, okay, this becomes our zone, this becomes our range. Ideally, it's the same thing here. If at all we saw a relatively big drop here and we failed to see the continuation down, that means, and we break structure, majority of the time it means that we'll make the same range, because the zone is the same. We'll just make this same range towards the upside. Okay, that's what this whole concept is all about. So we've said that we anticipate the break of structure there. So once the break of structure occurs at that point, now the next thing is now waiting for the bullish run to kick in. Okay, and for the bullish run, all you're waiting for now is a continuation up. Okay, sometimes you can even get this push pushing all the way up until the next zone. So remember how I was saying that we don't know where price came from here? Let's take a case of whereby price is coming from a supply zone here. That gave us a very significant drop. Majority of the time, what happens is this stop will bring us back to this area. Okay, so this is where we usually know that price is going to push from extreme lows, because it's taken out all these lows, to an extreme high. Sometimes it might even take out that area. And because this happened a long time ago, we just regard this as a level of profit, but not as an area of entry until we see significant structure change. Okay, so say for example, this push has taken us all the way up here. Okay, now if we can recollect the points that we are looking at, we've looked at these points. Liquidity buildup, liquidity supply zone formed, liquidity taken out, zone break. Now we've seen a push up till this point here. Okay, those are the key points you're looking at in terms of break of structure. Now what happens next is, once we get to this area here, as I've said, you're waiting for break of structure. Okay, sometimes the zone might be broken, but let's look at a case whereby the zone holds. Okay, so let's draw a nice line so that we don't make it look a lot messier than it is. Okay, so that's the zone there. So don't even think we need all this. You just need one there to make it clean. Take that out. Take this out. Yeah, there we go. So now we're here now. If price wants to reject from this area, what we usually expect to see is what I was mentioning, break of structure. Okay, and break of structure is basically when we have, let me erase this so that I can draw it here. Break of structure is basically a case whereby, if, for example, you wanted to see, if remember demand zones are forming as you push up, once you get to a point where we are overpriced, what price usually does is it breaks instead of a demand zone break respected, it forms it's broken. And what is left behind is a broken demand. And at the right point, keep in mind that at the wrong point, a break of demand means just the top of the next demand to push higher. Okay, meaning that if you have two demands taken out, it's just grabbing liquidity to push up. But in a case whereby we are at a selling point or a premium point, a break of structure will mean a shift in structure, meaning that price, if, for example, if you've broken this, price has formed an extreme high, that is a supply, and we've broken this, we've broken and closed below with a candle. So what price does next is it can come and just test this area or test this area. Keep in mind that if you've plotted your zone well and plotted, remember how I was telling you in terms of the kill zone points, whereby you have the 50%, you have the, let's say it was looking like this. And this was our zone, right? We have 50%, we have this point, have this point. Depending on which portion you choose to use, okay, what happens is, you can either say that this is your kill zone, so you'll be looking for lower time frame break of structure here. You can choose to use the whole of it, or you can choose to use just this top portion. But regardless of which box you choose, what you wait for now is break of structure, okay? Then keep in mind that we are waiting for this on M1, okay? Maybe we drew this on H1 or M15, we're waiting for this on M1. So once we wait for it on M1, and we get such kind of break, you can make your entry here and your entry here. But we've not yet gotten to that point. All we've just gotten to is now the third point here. So if those are the extremes and price rejects this area, that means that price has to go back to the equilibrium price. Okay, remember how you were saying that? I think there's even another example whereby, for those guys who've done physics, you remember that when we are forming waves, price will always, water will always go up. And then when it comes back to where it started. And then it'll go back down, but it will come back. Whenever it doesn't know where to go, it'll always go back to equilibrium. And so on and so forth. That's the same thing with price. When price knows its equilibrium point, price goes overboard, it always finds itself coming back here and trying to make a decision. Are we going up or are we going down? Okay. Then if it wants to go down, it can go down all the way. And then once it can't go even lower, it comes back to the 50. So most of the decisions are made at the 50%. So once we've broken this, we failed to break this. That means the next target that price will be going to is around the 50%. And majority of the time you'll find that there's a zone around the 50%. So let's plot that here. Don't think we need this. So price comes back down. So what did I want to do? Don't like this arrow. Can do it. Normal arrow comes all the way here. Then we see break of structure somewhere around here. Okay, then now we start shifting back to the 50%. Let's say 50 is around here. Okay, so the moment I look at a range as being filled, the moment you find me coming and mapping out my range extremes from this point to this point, is when I find that price has indeed, okay, let me revise this to this point, is when price has found itself going back to the 50%. And a bonus is when price has broken the 50% with one or two candles. Like you see, not just a break, but a close, meaning that the candle that was here, if it was a bearish one, it closes below, then the next one closes below. It's usually good because now it tells me that this is my range and I can comfortably look for sells within this top side and buys within this bottom side. I hope I've not lost anyone. So think we're coming to the end of this range section because it's the bulk. So we've said that what we want to see is price coming back down and doing something like this. Okay, now we have come to the most interesting part, which is now entries and exits. Remember how I was telling you guys about pending orders, using just pending orders primarily, and using stops and all that kind of stuff, and using more numbers of trades to justify your win rate. What if you just know how to plot ranges, you might be good enough, because what price normally does, and we'll look at the charts just now, price finds itself coming to this section, which is what we usually call the below the 50. Okay, below the 50. And there's also, now remember, initially we had only this and this extremes. Now we have these extremes, which is now now we have 3 areas. And what we will do from these areas is, when price is at this point, I mean, when price comes again to this point, this is a sell zone. But if price comes here, this is another sell zone. At 50, we don't do anything. Okay, when price is here, this is a buy zone. When price is here, it's a buy zone. If price is here, we don't do anything. Now, most of the guys were asking, when do we know which zone works and which zone doesn't work? When you have this range plotted out, when you have demand zones here, you ignore those demand zones. Unless you properly understood the markets. You just ignore those demand zones and you wait for price to react from those demand zones, but bring you to these supply zones for an entry. Now, here's the interesting part. You can either just, if you want to sell and price has not gotten to the 50, you wait for a zone to be broken here, price to shift back up and come into this area. And if it comes here, you will sell from here, depending on which zone you've plotted there, and you wait for price to come to the 50, and then price to come to this area. And then TP3. Then if price breaks this, you just leave a runner, okay? By the time price is getting here, there's usually majority of the time a 1:3, 1:4. Or if you've taken entry from the lower time frame, trust me, this can even get to a 1:5, 1:7. If price is quite bearish and takes out this 50%, usually know that this is the next area, almost assuredly. And then if price is very bearish, we know that, remember, these are buying points. So you need, whenever you're at a buying point, you take out positions, okay? So remember, we're not selling here, we are selling here. If you want to take sales here, which is still not bad, you just need to time it right, but you need to know that this demand zone left behind are areas of taking profit. But if you have that case whereby you've already formed these minor ranges, you can take the trade like that. Now comes the instance where we've closed below this area. Then that makes this level apparent for a possible sell, okay? Remember, initially it was this area. If we are still within this point and you wait for a break. Now, if we have a break already, usually wait for test of this and we go down. This one is only going to work if we've not, it can work. It works when preferably we've not touched a zone here, because what price will do, it will form liquidity points, then build liquidity, then come here, then take out all that liquidity. That's why I was sharing those concepts as we go. So now we've added key points here. We've said that we only sell. Let me remove this. Sorry. It's going to make more sense in the charts. And this works even on any time frame, trust me. As long as you know how to plot your ranges, majority of the time it works. I'll just show you guys just now. This is going to be your light bulb moment. So sells here or here, okay? Buys here or here. Midpoint, no trade. Now, during tomorrow's simulation, you'll notice that there are some instances that I'll actually take trades at this point, but the trades at this point are usually anticipatory trades whereby you anticipate a shift up or a break, but it's a very dangerous place to take. It's given that it's dangerous doesn't mean that you don't have to take. All I'm saying is that you need to be extra cautious in terms of taking your positions from those areas. Okay, so I hope I've not lost anyone. Now, here's where zones come in, because if you don't know how to draw zones, then you won't know where exactly to place. If it is a pending, you won't know where to place the pending. And if it is for looking for breakup structure, you won't know. So that's why I mentioned zones beforehand, because now all you look for zones either here or here, or you look for zones either here or here. Okay, so I think I have explained that as much. And then now all you'll need to do if you want to take it with a pending, you just place a pending from that zone. Then we also have this area. You can place a pending here or a pending here. But if you want to take trades with more confirmations now, remember we talked about break of structure, you wait for break of structure here, or you wait for break of structure at this point here or here. So I hope I have explained that. If anyone wants more explanation, I think you'll just have to wait for the afternoon, but that's ideally how I look at the charts now. Okay, so there are certain things that I will not mention here, but I'll mention them during the simulation because I don't want to like bog you guys down. It's already like 1.5 hours already. So what I won't explain, but I'll talk about it in the simulation session is I'll talk more about, let's add this. Let's first of all, it is. So to be in second session. Okay, so the thing that are going to be here during the second session is actually refining entry points. Okay, so this is going to be either manual entry points. I'll implement both manual and pendings. Pendings is usually mostly during sessions outside of NYSE, and then actual manual entries is mostly using during New York session. Okay, so this is both pendings and for pendings and for manual entries. Then what I'll also look for is trade management. This one I can't, as much as I might try and explain it here right now, you guys won't be able to really grasp the idea unless we're managing this in person during the simulation session, whereby you're seeing what I'm doing. Then also we'll talk about candlestick closes. Okay, what to look out for. There are some times that you'll be in heavy profit, but once you see a certain candle close, you just close out your position because price is going to shift in your favor. It's going to shift against you. For example, if you've taken buys from down here, or here, or wherever, and then you see a certain kind of candle close here, you automatically just close. If it goes continues in your favor, then you're still okay, but majority of the time it usually means a shift back down. Okay, so that implies big rejections, small rejections, solid closes, indecisive closes. All those are coming into this section here, and then maybe something I can refine here, though we'll still talk about it on the simulation, is session trading and session timing. Majority of you have seen that I only trade during NYSE or US30. Sometimes I'll take London session trades, but then I'll ride them into New York session. That's if I want to take a a swing or an intraday position. Okay. So primarily, if you want to scalp stroke intraday, you just need to take in the session. Session has the most volume, and you can be able to really take lower time frame trades and capitalize a lot on them. You get really precise entry points, and you get in and out within 2 minutes, 3 minutes, and you're done for the day. So that's the reason why I like US30 and NASDAQ on the open sessions. It's really good. It's really quick. As much as people don't like scalping, for me, I love it because it is quite fulfilling. And sometimes if you take a scalp and then price gives you, as I was talking about here, a nice candle close, you can hold it into a swing or an intraday, and you can still get really, really handsome profits. As I'll show you guys. Then what else? These fundamentals also play a really good fundamentals really just play along this kind of structure, because the certain days I've taken NFP and CPI trades even on gold, and it just plays perfectly with this kind of range analogy, blah blah blah. So majority of the things that are left are going to be talked about, but one last thing maybe I can bring up is let's squeeze these things in. Liquidity, break of structure. Then you can add something here. You can add correlation. Correlation pairs. So for your stat is just fix mortality index. So ideally, what we usually do is when we are trading our sessions, maybe before the session starts, we usually like going through the VIX to just more or less look, because ideally what happens is when VIX is pushing higher or pushing up, then we usually expect the inverse or the opposite on US30, meaning that if VIX is pushing up, we want to see US30 pushing down. Okay, majority of the time VIX is usually a leading like pair, so such that if you start seeing the push on VIX, then you should expect US30 to shift in the opposite direction soon enough. There's some times where US30, and especially we've seen that, I think, this past month, we've seen that VIX will really make a big push, but then US30 is stalling, okay? And what happens is it's normally stalling as it waits for VIX to get to a premium point or a discount point, after which, let's say, for example, price is pushing up on VIX, but you're not seeing the drop down on US30. It's because it's just building. Remember, we are waiting for the drop, right? It's just building liquidity. And once VIX taps an area like this, and then the thing is VIX closes 8 minutes after all these other candlesticks. So that means you usually time the VIX close. So once you time the VIX close and it goes against and taps this region and then rejects, that means if you start seeing VIX going down, we expect this to start pushing up. So this consolidation is just to wait for VIX to tap its area of interest, then we see a shift up. If you're seeing this stalling, what I usually normally do sometimes is just look through NASDAQ and try and see, is NASDAQ, because majority of the time is if one of them is stalling, that means you can jump on to the next one and it will give you more or less the same thing. So if it's stalling here, you just look at NASDAQ. Maybe NASDAQ has given a nice drop. I think we saw this last Friday or Thursday. And then after that, you can even buy from here and then expect a shift, because the VIX has done this and then now wait. So all we usually do is just, when we have VIX and US30, what we'll do is the same procedure we've mapped out a range is the same procedure that we'll do while mapping out a range on VIX. So we'll start with VIX first, and then once we know that, for example, we're expecting VIX to drop or to go up, we now look to US30 or NASDAQ to wait for the same kind of thing, but now on the opposite. Okay, so we draw our ranges and our zones of interest on VIX. And then once we are ready, and then we know that maybe it's this distance away, that means that we can expect a push in the opposite side for US30 before it starts giving us the right push to right direction. So I hope I've explained that. Now, hoping you guys are taking a snapshot of what is on the charts. Maybe I can save that, then I'll share it to the community guys. So I think now what you can do, let's see, when plotting your zones, you take into concept. I personally don't take consideration of the psychological numbers really, but they do play a big role in price. So if you just want to refine your entries, you can choose to use those psychological levels. So now I think we'll go straight into trading view and maybe look at a few examples before we just call it a session. So this is VIX. This is the volatility index that I was telling you guys. So now they don't really have different fundamentals really, because it's especially for US30 and US30 and Nasdaq. It's affected by dollar fundamentals, which is basically the same thing as for other pairs really. So basically it's just the same. It's just the same fundamentals. So even from current price here, we can more or less look at what is happening here, and then you guys will get a glimpse of what. Let's look at US30. I think US30 will give us a better understanding. Is US30 and hour. Okay, you can look at how this extreme point paid out so well, and as well as this extreme point. So if we look on the bigger picture, I believe I drew this off the bigger picture. I think it was on the daily or something. Yeah, this supply area. Okay, so we have this push from here. Let's look at just what is happening currently. Okay, so we have this high, extreme high. Okay, that we have all this structure. Okay, then we have so much consolidation. Then you have structure form, a low, liquidity that takes out liquidity, right? Previous liquidity and previous liquidity. Then what does price do? It shifts up, but then fails to take out these highs. So what we form instead are more or less equal highs here. Okay, so as we are forming those highs, is even something just on the daily, for example. You'll just see the relevance just now. We leave behind a supply. Remember how I was talking about a supply? So we leave behind a supply, you see a big candle, and then the next one takes it out, and then we break structure. So this was a structure we had. We see a structure break and close above. Then after as we were breaking, in this case, actually, this is a nice case, because as we were breaking this structure, we left behind the demand zone, right? So now you wait for this demand zone to hold, and we see the push up. So for us, our range beginning is here. Our range end is here, because after we got to this point, what did price do? Price broke structure, played around here, came back to our, this is actually the best case to use. Broke structure, and so what we were left behind with is an extreme point break of structure, and you can see after we break structure, we just continue breaking structure and breaking structure all the way back down. Okay, now given that we saw a very big push, very big bullish push there, let's plot. The fib is the easiest way to plot these levels, only that you need to refine it instead of 0.7 and all that, as we've refined it to 0.5, 0.5, 0.25, all that kind of stuff. And actually plot it the other way. So it is, okay, these are 0, these are 0, these are 1. Okay, so our levels of interest are this area, this area, this area, and these two other areas. Okay, now if you choose to just use these levels blindly, that means you'd be looking for once we closed below, you'd be looking for sells at this area. And if you were looking for buys, you just take buys from this level, okay? But if you have wanted to refine this swing positions, all you would have done is waited for price to get to this zone here. So rather than just using this level without considering like where to, you don't know where to place your stop loss, you just have that, this area, and then I'll push up. Now, what did I say in terms of like levels of interest when you're drawing a zone? You don't need to draw the zone, the full zone. Like you can still draw the zone like that, but then how do you minimize drawdown? I think that's P2 asked how you minimize drawdown. How do you minimize drawdown here? Look at how precise that would have been. Remember, your stop loss is still at the same point below the zone, but rather than having it all the way up here, you have it just below this point. And that will be a really nice swing because once we reject this area, our TP1 is 50%, our TP2 is this area. And once you start seeing break of structure at this area, you can start saying, okay, no, this seems like it is going to be going against me. So you close out on most positions. Remember, you took TP1 here and TP, all those TPs there. So you just wait for your overall TP here. So let me see the charts. Yes, that's actually what I've just said. I customized my fib. Everyone just uses the normal kind of fib. For us, we've refined the fib to just map out the, I think I can also see raised hands. I think it's the same guy. My fib is just using, can look at levels. Maybe let me share this. Snapshot of this. See. Okay, so if you want this, you can just take a screenshot of this. It'll help you. All we need is just the 0, 0.25, 0.75, and 1. That's all we need. Okay. I mean 0, 0.25, 0.5, 0.75, and 1. That's all you need. Okay. You don't even need all these other ones. So you just need to customize it. Does anyone else have a question? If not, we can progress. So just look at how precisely that works out. Say, for example, you missed this area and you are looking for sells because price has left you out on buys. Now you're looking for sells. You'd have used the same analogy, but rather than using this, remember down below is a buying area, right? Up there is a selling area. Which zones do we have that are near the 50 above the 50? So we have this one, which is at the extreme. We have this one here that is the one that ended up being respected, and we have this one. Now, why did we not have this kind of situation? Why? Look at this. Look at this. This is actually going to be very interesting. Look at this zone. Why did we consider this area and not this area? Because this area is what gave us this push. So rather than using this area as a demand, most people would have drawn this demand here. And then they would have faulted this as a break below the zone. There's something we call origin of the push. Where did all this push come from? Like, is this the first time prices? Is there another zone is this the zone that caused all this? Yes. So that makes this our area of interest. So the same thing happens here, okay? We have this drop that forms, so that is our area of interest, okay? For here, we have this drop, this is our area of interest. If anytime you see so many candles forming like this, you just refine it by going to the next higher time frame and you'll find something interesting. But at the same time, you can see that regardless of which area you picked, we barely saw a close above that area. Actually, let's refine this zone. Okay, you can see we barely saw a solid close above that. We're just seeing a liquidity, then now we drop down. So this is TP1. If price decides to push all the way down, it's still going to happen. Let's even forgo that example. Okay, let's look at another one. Let's even say price was still here. So we have this drop from here all the way here. Okay, what happens is we have this supply, this, and then now we have this area. So actually the best thing would be if we go to the H4. I think H4 will show us that region in more refinement. Okay, so this is our zone. We have, yeah, I can see Keisuke Baji has raised his hand. Is it possible for you to type the question, or if you can't, I can still guide you on that? Is it possible? Let me unmute him. Ask your question, bro. Let me unmute you. You can ask a question. Or if you can't, I can, let me just look at the chat.
Oh, hey, Bossman.
Yeah, hi.
How are you?
Good. Talk to me.
I wanted to ask if when you are using the fibs, do you use the fibs first, or do you place your SD zones first?
You can't plot your SD zones, because if you start plotting your SD zones, all will happen is you'll draw all the zones. For example, from current price, if we were starting by drawing our zones, we'd end up drawing how many zones? Let's see. We would have ended up drawing this. We'd ended up drawing this, then we come here, then we draw this other one, then we come here, and then we draw this, and then we draw this, and then we draw this. But you don't need all those zones. That's why I've reiterated that. The first thing is you map out your discount levels and your premium levels, which is aided by the fib. Okay. Once you, all you need is just, once you draw the fib, like even for this case here, once you draw the fib, you know that which are the only zones you need. You only need, let me draw, you only need this area here or this area here for demand. And you only need a supply zone here or this supply zone here. So you'll stop drawing all the you will stop drawing a supply zone like here, because all you're waiting for is this supply zone and this supply zone. I hope I've answered your question.
Oh, okay, yeah, yes.
Yeah. Then after just plotting your levels, what I usually like doing, just 1 minute. What I like doing is just once I draw the fib and I know where my levels are, I'll just pick a horizontal line. It will tell me where I want my levels. For example, if you're closer below, all I'll do is just plot this level here first, and then plot this other level here, maybe plot the 50. Okay. Then all I'll do next is, after I delete this, because today I'm only looking for buys, I'll look for zones that are within this region to complement my buys. Does that make sense?
Yes, it does.
Yes. So now, like, this is another example of a fib kind of case. So we have build-up of liquidity. So we have a low, close to like equal lows there. Equal highs there. Then we have a significant drop. What did you say? We have a supply zone here. Supply zone is broken. So where is our range? At the most extreme high. Because once you are here, if we would have considered this as our range from here to here, we failed to go even below this week. Remember, we said that for the range to be complete, we need to go below the 50. Right?
The 50 equilibrium state.
Yes, exactly. So if we're not at the equilibrium state, then that means that this range might still be forming. That's what I was saying. You remember when I was plotting the zones, I said you can, because this is a region whereby we had the drop, we can still try and anticipate sells here, but because we've not yet broken the 50 back to the 50, it makes the sells quite hard to play out, because you can see we still had break of structure here, but we didn't see a drop. We still had break of structure here, but did we see the drop? No, because we need to frustrate traders in this kind of fashion until we trap enough people. Now people will see we broke above this, so they'll try start buying. That's when the break of structure comes in, and then we break this, and eventually after breaking this, after a frustrating number of tries, you get one nice solid candle close below, and it progresses all the way down until this point. So for me, if you're patient enough, you can look for sales at this point, because normally they're usually rewarding, but you time them really well. But then if you are patient enough, you will just wait for price to break back below. Now you can see we have one, two, three, four candles that closed below even this bullish one. And so that those are like 5 candles. So it makes the break was solid. So we know that there's a possibility that if price pushes up fast before coming down, we can see a rejection of this area, and then I will push down. So what I'd anticipate even for today's session, maybe if I was to trade it, would be I'd wait for price to maybe drop below, come to this area, see a shift up, come into this point, sell. So if price does come down to either this point, it might even just come and tap this point here, this 35,000, as the guy for the rounded numbers was saying. It might actually come, take this, come back up, and then tap this area. So if you are looking for buys, you'll just wait for break of structure here during New York session. And then after that, you take buys, and TP1 will be here, then TP2 will be this area as you start looking for selling opportunities after that, selling opportunities here, and then now you take price all the way down to if it wants to get back down. Remember, this first time we only had this kind of structure, and we've not yet tapped this area, meaning that we might be looking for buying opportunities here in the future, one of these 2 areas. So you have to keep that in mind. So normally how I usually get into sessions, always where I usually take profit for buys is where I start looking for sales. And when I start taking sales from that level, I'll wait for a shift again for buys. So that's how I usually plan out my trades. That's why it'll always seem like I'm just from taking buys, and then immediately I take profit, I'm already in sales, and so on and so forth. I think there was another raised hand. Let's see. Yeah, you can unmute yourself. I've given you rights to do so. You can ask your question again.
I think that was all. You've answered everything.
Okay, no problem. So this is another case of zones. I mean, supply and demand playing out perfectly. So one thing I want you guys to take home is whenever price is extremely, I've noticed that majority of the times usually take break-evens or we miss trades. I think it happened the first week of December. One of the members was actually right. He called buys, but then I was in sales already. I sold, and then I was in profit. Of course, I did close out my profits, but it was less rewarding as opposed to the buys we would have taken, because it was literally the same setup that we're seeing here right now. I literally sold when we were close to the 50. But for him, he called the buys, but now since I had said that I'm looking for sales, he was a bit cautious. And then price ended up going in his favor for quite a couple of pips. So if that day, I think that day I was just from doing some errands, my mind was a bit exhausted. That's why we didn't do the full analysis. But if you would have done that, it was literally what happened here. You see this area, we sold from here to a point like here. And then the moment you are taking partials, you should have been looking for buys instead, because you are at a discounted point. You will have caught the whole push up. It is literally exactly what happened here. And it's a coincidence because it is still on Monday. That day was on a Monday. I remember it was like, the member, he's called Alex. I don't know whether Alex is here. So, so you guys are saying there's no sound. Can you hear me? Okay, so guys are saying sound. So we have like another 15 minutes or so. Maybe we can look at, we have actually 10 minutes or less. Let's look at other examples. Let's look at other examples. Rather than looking at the 4, let's even look at the 1 minute, for example. Because majority of the guys want to, this is another example of build up of liquidity. Remember how we're talking about build up of liquidity? We have, the first time was a liquidity point. We tried, we broke up, but we failed to give a significant push. We come here again, we build liquidity, we struggle again, we build liquidity again. So if we're not going up, we need to go down. So what happens is price goes down to the next possible area. And the best thing is, if we look at the charts here right now, this push took out all this liquidity, okay? So which range will we use? We'll use the range from this point to this extreme high. So if you draw the fib, because that's where we've seen the big push, where does price shift from? Price shifts from this area. In a case like this, whereby you don't have a zone here, because if we zoom in, we don't have a zone. What you do instead, you zoom in to this area. What you do instead is, since you still have this extreme low point, you can now use a pending here, okay? But now, similar, if you don't have a zone, you can use a pending. But if you have a zone, use the zone. This is even on the M1. So the question about calculating risk and position sizes is going to be during the simulation session, because that's more hands-on. That's more hands-on. So you can see how we perfectly reacted to this area, and then now break of structure is what gives us a confirmation. If you didn't want to take the position aggressively, taking a trade based off break of structure is usually the better case, because when you see break of structure and price starts shifting up, we leave behind during the retest, during the break. No, when we drop, we form a supply. When we break, we form a demand. When price pushes up, we form a range. When price comes back down, we have a demand here. And you'll notice that if this is the minor break of structure that we had, this is still a range, minor range. So all you'll do is you can take the trade at that point or at around this area. There's also usually sometimes a zone around here. Then you can either take from that point to this point, and then I wait for the continuation up. Literally what has happened here. We had break of structure, we left behind a zone, then we formed a range, built liquidity, took it out, then pushed higher based off this area. So it's basically as easy as that. So now I think for me personally, I am done with this session. So all that is left is now the pointers that I had mentioned in terms of let's come here, in terms of what you're going to look at. You're going to refine the entry points, look at trade management, candlestick closes, and then that's going to be during the simulation session as well as the sessions. So cheers guys, and see you guys in the afternoon. Try and digest what we talked about today, and then during this session, and then we'll be good during the New York session. So what I can see, Kiyosaki has another question. You can drop your question in the chat box. Let's say you took the challenge from FTMO and they don't allow news trading. You see, the rule with FTMO is that you don't get in a trade 3 minutes before, and you don't take a trade 3 minutes before and don't close it within 3 minutes after. So as long as you do it within that period of time, as long as you don't get your trade triggered in within that period of time, then you're good. What I usually do normally is, if I really need to take a position during news, I'll just take it on my personal account and not a challenge account. But if you only have the challenge account, all you'll do is just, if you have a challenge account, all you'll do is just maybe get in the position maybe 6-7 minutes before. Just keep in mind that you might have a bit more drawdown, but then it will still go in your favor. So yeah, I hope I've answered your question, Pete. Yeah, is there any particular time frame you use? For me, all I do is I take my positions off the 1 minute and the 3 minutes. So yeah. So cheers and see you guys in the afternoon for another lovely session. So cheers. Let me snap this. What about a scenario where price moves aggressively from 10 to 1? That's the time that you take the loss. Losses are inevitable. So losses are always inevitable. So just plan accordingly. That's why it's a game of probability. So cheers. The meeting will end in 3 minutes. So cheers. I don't know, and I don't use Wyckoff. And how exactly do you take entries on M1 and avoid bad entries? That's what you're going to see during the simulation. You're welcome. You're welcome. So see you guys in the